Uganda's mobile banking sector has expanded significantly. By mid-2025, transaction values had surged to over 28%, while transaction volumes grew by more than 20%. This growth was driven largely by person-to-business payments and digital lending. New accounts continue to rise, underscoring strong digital adoption. Despite this progress, growth remains constrained by policy challenges. Sector players, including MTN MoMo, argue that issues such as absence of a national switch, a platform that could reduce transaction costs between banks and wallets, must be resolved in 2026.
Whether it is next year or 2027, that national switch is coming. We have seen markets where national switches have been rolled out and the impact it creates. So providers, banks, fintechs that tend to hold back and cling onto their own ecosystem are hit the hardest. Those that are embracing that interoperability actually benefit the most. So, and what does the national switch do? It brings down the cost of transactions. Because when you have bilateral arrangements with different entities, sometimes the cost is actually much higher because there are several third parties in there that are, facilitating the connectivity. And therefore, even as you try to figure out the commercial model, you find that at the end of it, the customer is paying a little bit more.
The rapid expansion of mobile banking has also made the sector a frequent target for taxation. Year after year, new taxes are imposed, raising the cost of doing business for telecoms and customers alike, with customers bearing the heavier burden.
What happened initially is that customers that were receiving monies or that wanted to be sent money would say, would ask for the money to be put on their mobile money, and then they push to the bank. What happens next? They go to the ATM or the bank agent. What have they done? Bypass the 0.5% tax. By the way, transactions of over 500K dropped significantly on the mobile money platforms because, it is natural. The higher the amount, the higher the tax. 500K attracts a tax of 2,500. That's a lot of money. That is over and above the charge of withdrawing 500K, which is 7K. So that takes the fee to 9.5. And that's why you see the customer saying mobile money fees are very expensive.
For sustainable growth, industry leaders emphasize the need for lower costs, enabling innovation and long-term sector development.
About 56% of the inflows are coming from the agent network. How do we continuously bring down the inflows to grow alternative inflows? Alternative inflows include digital lending, because that's new money coming in, inbound remittances, bank to wallet, money coming from another ecosystem to our ecosystem. So as we grow those are actually, they should cost less. Those should cost less to a provider.
The relationship between banks and mobile wallets has evolved from rivalry to collaboration as both sectors are increasingly dependent on each other's success. Yego anticipates more partnerships between banks and mobile wallet providers this year.
We're going to deepen collaboration with the other fintechs, fellow fintechs, the banks. Merchant interoperability needs to happen, very crucial. We've done it between ourselves and Airtel, where it's happening with the banks, but on the bank side, the cost is still high. Until we bring it down, the number of users, I can tell you the number of users who send money to the bank on our side is less than 200K of the over 14 million. But how many bank accounts do we have? Millions. I've not been tracking that, but there's a huge opportunity there.
Market analysts project that Uganda's mobile banking sector will continue to expand at 25% between 2025 and 2033, reaching $1.15 trillion by 2033. Betty Ndagire, NTV Business.